You've probably heard the statistic that 90% of people lose money in the stock market. Crazy, right? For something that supposedly always goes up over time, how do so many people lose money investing in stocks? And more importantly, how do the remaining 10% of people consistently make money from the stock market? I found the answer from a pretty well-known stock market expert, and believe me, the answer changed my perspective on trading stocks. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Buffett's first bit of advice is, avoid buying individual stocks. At first, this might sound strange, especially when discussing someone like Warren Buffett, often hailed as the greatest stock market investor of all time. However, the truth is, most people misunderstand how the stock market works, and Buffett himself tried to clarify this. Let's break it down. Think about when you first started investing in stocks, perhaps in your 20s or maybe in your 30s. In an interview, Buffett revealed he began at the age of 11. Initially, he approached stocks the way many beginners do, by watching prices rise and fall. He shared, "I read books on technical analysis, like Edwards and Meiji, which was the classic at the time. I went through hundreds of pages over and over, thinking predicting stock movements was key." It wasn't until Buffett read Ben Graham's teachings at age 19 that he realized he was on the wrong path. After this revelation, he shifted his focus from buying stocks to investing in businesses. The key takeaway here is this: don't treat stocks as mere price tags. Instead, view them as ownership in businesses that can deliver long-term value. Avoid chasing market trends. The real opportunity lies in the quality of the underlying business. It's this shift in mindset that transformed Buffett into one of the most successful investors of all time. Patience, Buffett says, is essential. When you buy a stock, what's the first thought that crosses your mind? For many, it's the hope that the price will rise quickly. But the stock market doesn't operate like that. It shouldn't be treated as a short-term gamble. Many traders buy and sell stocks based on short-term price movements, often holding their investments for just a few weeks or months. This is a common mistake and one that very few are able to pull off. Studies show that approximately 80% of day traders lose money, emphasizing the difficulty of consistently making short-term profits. Buffett also once explained, "Most people think about stocks the wrong way. They hope prices rise quickly, and if they don't, they feel bad. I, on the other hand, feel better when the market drops." Why? Because Buffett sees opportunities to buy more of the same business at a discount while others panic and sell. Market fluctuations are normal. During the COVID-19 crash, for instance, while many sold off their holdings, savvy investors bought aggressively and reaped huge rewards as markets recovered. Importantly, Buffett argues that succeeding in the stock market doesn't require extraordinary intelligence. Contrary to popular belief, a high IQ isn't necessary. As he put it, "You don't have to be a genius. What I do doesn't require brilliance. In fact, a 170 IQ may perform worse than a 120 IQ because success comes from having the right business sense." What he's really saying is that anyone can succeed in investing with the right approach, even without a fancy degree or exceptional intellect. It's all about understanding businesses and making smart, patient decisions over time. Take two examples. In 1988, Buffett bought over 14 million shares of Coca-Cola at $41 each, turning it into one of Berkshire Hathaway's biggest holdings. He didn't focus on the stock's short-term swings, but rather on the company's long-term potential. Then, in 2016, despite his earlier reluctance to invest in tech, Berkshire took a huge position in Apple, acquiring 916 million shares worth $180 billion. That move paid off big, with a 400% gain, showing how understanding the business itself is what really drives success. Buffett is also a big fan of index funds, especially for beginners. If you don't have the time or expertise to research individual companies, he suggests going for broad market indices like the S&P 500. This approach allows you to ride the wave of overall market growth without the stress of picking out the next big stock. Fun fact, the S&P 500 has delivered an average annual return of about 7% after inflation, and that is enough to make you very rich if you're in it for the long haul. So what's the secret? It's not about trying to pick the next big stock or timing the market perfectly. It's about buying into solid businesses and holding them for the long run. Sure, the market's full of ups and downs, but Buffett's genius isn't in predicting short-term moves. He's all about understanding the companies he invests in and letting time work its magic. And guess what? It works. Buffett proved it with Coca-Cola and countless others by sticking to the basics. So forget about quick wins. If you play the long game, the market will reward you big time.